Hey Morgan, thank you very much. Let me see. You can't hear me, can you? Morgan, can you hear me?
Hey Peter, we can hear you. So, and everybody,
Okay.
you guys should be able to see a slideshow.
All righty, great. Listen, Morgan, first of all, thank you for having me. This is always so darn much fun to talk about trading, making money in the markets. There's a lot of ways to skin a cat. I so much appreciate Hubert, man. He's fun to listen to. And I'm going to give you a way to make some money here that might be a little bit more relaxing, but it's been so darn good and it's been so lucrative. I think you'll like it. So this isn't necessarily designed to replace anything you're already doing, but boy, it can sure create some nice income for you and build some your account up. So let's just take a look. Let me advance this here. My name is Peter Schultz, and I am the founder and publisher of Cashflow Heaven. And we publish several different strategies for bringing in more money, more cash flow. That seems to be what a lot of people really need. Also, I'm just kind of looking down here in the comments, and Leland, I just want to give you a shout out. Thank you. I appreciate the support. It feels good to get a little welcome here, so that's nice. And I personally, as you can see on the slide here, am the chief strategist for the winningsecret.com. And that is exclusively dedicated to selling and making money with credit spreads. And I don't know if you've done credit spreads before, and I don't know if you're familiar with them, but it's an income strategy. But the way we do it, it's also a wealth building strategy, and I'll show you how to do that, how you can build that income into some pretty serious money. Like I say, if you've traded credit spreads before, you're actually going to learn something new here. There's some really, really cool things that have just been available to us in the last few years. If you've never traded credit spreads before, I think this is going to be a huge eye-opener for you. I mean, you're never going to look at options the same again. I mean, this is the coolest thing when you really start stacking the deck in your favor. So before we get into the details, let's take a look at why we're doing this strategy in the first place. So what's your reward for learning something new? So we all like to learn. We're all on, it's really fun listening to these presentations, learning some new things. It takes a certain amount of energy to learn something new. You got to study it. You got to figure some things out. So what's your reward? Why should you do this? What's in it for you? So if you learn to bring in enough income that is not based on your labor, you will be financially independent. So once you understand how to do this, you can be financially independent, and you can do that for life. Now, one of the funnest things for me about this strategy is knowing that I can go anywhere in the world, I can get an internet connection and bring in income, and bring in plenty of income to make it for a month easily. And like I say, things have gotten a lot better. So the question is, and what you should always be asking yourself is, okay, so there's things that you can do, and then there's what is likely that you can do. What's the probability of being able to do this? And as you'll see very soon, your probability is very high. And one of the really cool things about this strategy is I get to meet traders all over the country and actually all over the world, a lot of whom are retired and are making almost all or a huge supplement to their income doing this. So as you'll soon see, this can create quite a bit of income coming in. So we're all traders here, and I assume you're already trading to become financially independent, something we all kind of have in common. So how is this different than the trading you're already doing? You already got a bunch of cool stuff you're doing. So how's this different? What makes this maybe better? Maybe something that you should try. So there's two big differences. The first is your likelihood of winning. In this presentation, you're going to learn how to create a mathematical expectation of winning of 80 to 90% on every trade you make. And I can actually show you how to make it a little bit better than that. So I don't know if any other form of trading that's that high. I mean, most trading that I've done, directional trading, you put in stops, you put in stop losses, and stocks can be kind of crazy sometimes. You get the right setup, everything looks good, it looks like it's going to break out, it looks like it's going to go in a certain direction, and lo and behold, what do you know, it reverses. You look at a chart, they're going up and down, they're all over the place. So the nice thing about some directional trading is you can make some pretty big money when you win. The bad thing is you can you can lose quite a bit when you lose. So I really like having this mathematical expectation of winning. It's very relaxing. It gives you a lot of confidence, and you go into trades expecting to win, and you start winning on enough of them, and it really gives you the confidence to keep trading and keep doing it. So the second big difference is the ease with which you make your profits. So, you know, there's a lot of great trading platforms out there. There's a lot of ways to trade. Most all of them, you kind of have to be on it. You got to be watching your charts. You got to be watching your positions, your position sizing. You got to be really watching things and being on it and being very active. Now, there's a place for that. That's fun, but there's also a place for having a whole lot of money rolling in that you don't have to watch so closely. So the cool thing about this, and what we're going to show you here, is how to stack your trades so heavily in your favor that in most cases, once the trader's entered, you don't need to do anything to win. It happens automatically with or without you. And I just love that. I love making things easy. For most of us, you know, it's hard to be Johnny on the spot all the time. It's hard to be like super alert and super on it and just clicking in and out at exact right instant. And, you know, if you blink or if you get up to go to the bathroom, you know, your trade turns around and bites you or whatever. That might be fun to do with a little bit of your money, but it's really nice to have something where it's just working in your favor all the time. So just to let you know how this works, about 2 positions out of 10 will need some adjustment. The adjustments aren't difficult. They're actually kind of easy to do. But the rest of your trades, about 80% of them, just gradually fade into the night and expire, and you end up keeping all the money. So what is the strategy and why does it work so well? Well, first of all, it's an option strategy. And trading options, the way most people do it, can be challenging. I've been an options trader, it seems like forever. Done a ton of directional trades, made a lot of money trading options, lost some money trading options. If you're an options trader, you know what that's all about. So most people buy options on a stock they think is going to really move in their direction with the intention of making a killing. That's why people get into options. They get in for the leverage. They get in to make a really, really big play and make a killing. Well, a killing is often what happens. Unfortunately, it's not always in the way they were hoping. So people, they get into trades and they reverse on them. Oh, I've got some questions already, and I'm going to answer, all of them towards the end. But as I come up, I'll try and answer them. It says, "Are you going to talk about adjustments?" Absolutely. Adjustments are really, really important, and we're going to get into those. If you like to trade spreads, you're going to learn some stuff. This is going to be cool for you. So. So sometimes with options you can get some surprises, and when they do reverse, you can lose your money very, very quickly. So the reason that trading options is a challenge for everybody, it's not just you. If you've had some challenges with it, don't worry about it because you're pretty normal. And the reason for that is you have to be right on both direction and timing. So there's nothing worse than being right on the direction. You were right, but your timing wasn't right, and the thing reversed, eventually turned around, but not before you lost your position. A third factor that you have to get right, most people don't consider that because they're just looking at the charts and they're just looking at direction and trend and magnitude of the trend. But a third factor most don't consider is implied volatility. So I don't know if you've ever had this experience, but when you buy an option, you think maybe it's going to go up. It does go up, and you still lose money on the darn thing. This is really, really, really frustrating. And the reason for that is when you bought it, maybe there was a lot of action and there was a huge amount of implied volatility. The option premium, the time premium was really, really pumped up. And you bought that option and all of a sudden it deflated. The volatility went out of it and the stock went in your direction. You still lost money. So that's really, really frustrating. So if you're an options trader, if you've considered trading options, you know it can be pretty darn challenging. You can make a lot of money when you win, but most people that I know eventually end up blowing out their accounts, and that's where this strategy is really, really going to be refreshing for you. So there's many estimates to the percentage of options that expire worthless every month, but most come in somewhere around 85%. So I read just a report that was done on the CME recently. They did 5 different options markets, and the guy actually came up with about a 77% figure. If you go to the CBOE, they'll say, hey, that's not true. Everybody disparages options. It's not true. Only about 35% of options expire worthless, and 60% of the people bail before their option becomes completely worthless. So that's kind of splitting hairs, because if you go 30% and 60%, it's around 90%. So if we just use this 85% figure, the vast majority of options expire worthless. Okay, so what does that mean to us? So here's something to consider. according to the Options Clearing Corp, over $1.2 trillion worth of options were traded last year. Now, last year was the second highest options volume in history, and there's a really good chance that this year it's going to break the record. So they're projecting even more options volume this year. So that's $1 trillion changing hands. $1.2 trillion worth of bought options, and somebody received that money. So that's a huge, huge, huge amount of money. The options market is big, and it's getting bigger all the time. So if 85% of options expire worthless, where does all that money go? You know, when I used to trade options directionally a lot, I would, my money would disappear, and I'd think, where in the heck does all this money go? Is there some big pile of money piling up somewhere? Because all these people are losing money on options. You know, their options are expiring worthless, or they're at least worth less than what they paid for them. Where does all that money go? You know, does your broker get it? No. Does the market maker get down on the floor get it? No. But what's kind of cool about options is that it is a zero-sum game. So for every dollar that gets lost in options, with the exception of a little bit of slippage, a little bit of bid-ask spread, a little bit of commission, but every dollar that gets lost ends up in somebody's pocket. So who gets it? The options sellers. The options sellers are collecting all that money. Now this should really make your head spin. Let's do a little bit more kind of intriguing math here. So it's estimated that there will be about 1.4 trillion worth of options bought and sold this year. So that's up from last year. So if 85% of them expire worthless, that means there'll be an astounding $1.19 trillion worth of expiring options premium that year. Now, think about your own monetary needs and think about what slice of that, what percentage of that do you need to live really comfortably every month. And I suspect even if you have a pretty big overhead lifestyle, pretty thin slice of that's going to set you up. So to put that number in perspective, that's $1,119 billion worth of premium that option sellers are going to get to keep just this year. And that number keeps growing every year. So, I mean, these numbers are kind of mind-boggling. They're kind of fun to look at, though. So if we're going to be an option seller, if you want to become an option seller, if you want to jump on the high probability side of options trading, what kind of option seller should we be? So the kind of options that most people are familiar with, options selling, is covered calls. Now that's where you buy a stock. Say your stock runs up to 18 and you say, well, I'd be just delighted to be able to sell it for $20 a share. You own the stock at 18, you sell the $20 call, and it either gets called away from you and you sell it at 20, or you get to, it doesn't make it to 20 and you get to keep your premium. So that's the way probably most people sell options. Now, that's great. It's a cool strategy, but I just got two problems with it. Number one is it costs a heck of a lot of money to buy the stock. I want to get my money working a lot harder than that. I actually want some leverage in the deal. That's one issue. The other issue is if the thing reverses, you got a lot of money to lose there. You got $18 that you could possibly lose. I mean, that's just too much for me. That's too much. So covered calls, people like it that own stock portfolios. They get a little bit of income from their portfolio. That's great. It's nice. I got a better strategy. I got something I think you're going to like a lot more. So how about naked options? Why don't we take a look at that? Well, selling options naked, I don't know if you've done it, but some people do it on low price stocks that they want to own, get paid to own the stock, but a lot of people do it for speculation, and if that thing really drops or really goes up, runs past your sold strike, you can lose a fortune. So not interested in selling naked. There's way too much risk there. So how about this strategy right here? How about credit spreads? So that's what we're talking about here, and that's what we're going to do. So let's take a look at credit spreads. Let's take a look at what they are, how we can use them, and how they might be good for us. So this is just a quick chart here. This is on the S&P 500. That's probably the most well-known, heavily traded index in the stock world. And a credit spread is where you sell an option to collect the premium and then sell an option further away from the stock to hedge. So if you're familiar with this is just like second nature to you. But if you're not, let's just take a look at this. So what you do is you sell this option. So this is the 1775, and we're going to sell that for $5.20. See that right here? And if we were just to sell it right there and leave it there and collect that $5.20, we would be selling naked. Now, the problem with that, that's great. The problem with that is if the stock just drops like a rock here, we could lose all the way down to zero. It's just too much risk, and to tell you the truth, your broker will not like you doing that, and for most people, they cannot even sell naked. That the margin requirements are just huge for that. So we want to really hedge this. We want to protect ourselves. We want the income. We want that premium coming into our account, but we want to do something to protect ourselves. So right down here, you see that we are buying another option, and that's just $5 away. That's not very far. So we're selling the 1775. We're buying the 1770. So we sell the 1775 for $5.20, and we buy the 1770 for $4.70. Now the difference between those two is 50 cents, and that's our credit. So now maybe 50 cents doesn't sound like a lot of money to you. I don't know, but just add a zero to it. So you do 10 contracts on that. That's $500. You do 100 contracts, you got $5,000 hitting your account. So you can scale this up as high as you want. Everything that we trade is super liquid. So no matter what size account you have, you can you can make as big a trades as you want. In fact, there's a gal named Karen. She's a super trader. I featured her in some of my other webinars, and she's managing I believe over $100 million now selling options. So there's plenty of depth and liquidity here. So whatever size account you've got, it can accommodate you. So let's find out what our return is. What are we going to make? So we're just bringing in 50 cents on a $5 spread. So 50 cents. So the most we can lose on this is the difference between the strike prices. So if the SPX rolls over and goes all the way down through both of these strikes, we would lose the maximum. Now that's never going to happen. We're never going to let that happen, but that's the worst case scenario. So 50 cents divided by 450 is 11%. And as you can see here, now this is something that I just took off the options chains today. So this is actual, these are real numbers. And so we can see right here, we're selling right here, and we are going out to the end of January. So this is just about 3 weeks at a time. Options expiration is tomorrow, so this is 3 weeks. So 11% for 3 weeks. Now, bond traders, dividend stock traders are getting 2% a year. They'd kill for this kind of a return. If you told them about it, they wouldn't even believe you, 11% in 3 weeks, but guess what? It gets better. So what we're selling here is puts. Somebody asked, are these puts or calls? So these are down here, and we're selling puts. And the idea here, what the object is we want this whole thing, this whole spread to expire worthless. So what we're doing, just so you know what the game is, what we're doing is we're selling options that we don't think are ever going to see the light of day. We think that they're going to just expire. So once again, we're selling right now, and we're looking out to actually January 31st, which is a weekly option. Somebody's asking that, and January 31st is the Friday that we're going to sell on this. Okay, so does everybody kind of get that concept? So what we're doing is we're selling an option, a put option, 1775 puts for 520. We're buying the 1770 puts for 470 to hedge, and that's our protection. That makes it so the maximum we can lose is the difference here. But we've already taken in, so we took in 50 cents. That's the difference between these two. And so we can never lose that 50 cents. So the maximum we can lose is 450. So we're making 50 cents, and we could possibly lose 450. But here's the cool thing about this. The likelihood of losing is super low. We got some great I love you guys' questions, man. You guys are on it. Where's your sweet spot, Kent? I'm going to talk about that for both time and how far out we sell. I'm going to get to that. We got some good slides on that. What's the margin required? The margin is $4.50. So you're assuming the same number of contracts on both sides, Mike? Yeah, that's exactly correct. You do the same number of contracts on both sides. What if we get assigned the stock? Can we buy back the spread? Yeah, if you get assigned, you can just sell the thing. IV higher, better than 35 or better. That's Charles asked. Yes, we try, and I'm not going to get into volatility on this, but yeah, in my courses I do, and we want to sell higher volatility. What's the price of the S&P? You can see it. It's 1836.95. This is an actual chart right from today. SPX is cash settled. Thank you, GA, that you cannot get assigned, and we love that about that. Adam, do we leg into these? Yeah, absolutely I do. I love to leg in. I set this entire spread, but if we do a condor, well, I'll show you the legging in part. So let me just carry on here, and I'm gonna keep answering questions as we go, but let me get on to the next screen here. So an 11% return for 3 weeks at a time is pretty good, and you can get rich with those kind of returns. Now imagine if you got 11% on your money every 3 weeks. Get out a calculator and see what that turns into. It'd be huge. And you can get rich with those kind of returns, but can we even do better? Now, keep in mind that the name of this presentation here tonight is extraordinary returns. So you heard about credit spreads and people are making, whatever. I want to do a lot better. I want to show you how to make extraordinary returns. So what if we could double our returns while keeping our probability of winning the same? So how are we going to do that? What we're going to do is we're going to sell another spread above the stock and bring in another credit, but you get to keep the same margin, more than doubling your returns. Now this is really cool. See, what's happened with options trading and credit spreads over the years is it's just getting better and better and better. I first started trading options back in the mid-90s, and it was challenging. Things have gotten so better. So one of the things that's gotten better about it is back in those days, if you were to put on this bottom spread right here, and then they'd make you hold this $5 in margin, and then you went to put this top spread up here, and we're talking about the same expiration. So this is the expiration, this line right here. Same expiration, same number of contracts. They would make you hold another $5 on the top side. They don't do that anymore. The brokers have figured out that, guess what? This stock right here, it might go up, it might go down, but it cannot close both above your call spread and below your put spread at the same time. It's just physically impossible. So if you do these, you are going to get, they're only going to hold credit for one side or the other. So here's what's cool about this is we're going to sell the 1885. So we go way up here. We sell the 1885 for $2.20, and we're going to buy the 1890. So that's $5 out again for $1.70, and the difference is 50 cents once again. So $1. So now we've taken in 50 cents on the bottom here on the put spread, and we've taken in 50 cents on the call spread. And let's see here. Okay, that's a little bit big. Okay, so we've taken in 50 cents on both sides, and that gives us $1 right here. So this is what we've taken in, but here's what's cool. Since the stock can't close above and below our two spreads here, they're only going to make us hold the $5. So $1, now our margin hold is only $4. You can see that right here. $1 divided by $4 is not 11%. It's not double 11%. It's 25%. Now I want to, GA, I love your comment here. I do this every week with great success. The people that do this, once they get into it and do it and get familiar with it, it's just like clockwork. You just don't worry about it. You get really comfortable with it, and you just keep bringing in this money. I just think about all those people out there that are kind of hurting for bucks and need to bring in a few dollars, and this is just a really, really great way to do it, and you don't have to be super, super fancy. I mean, if you just do what I'm showing you here tonight, you can do really well at this. So here's what's amazing is now we've got a 25% return for just 3 weeks at a time. And once again, these are not made up numbers. Yeah, this is Fred Michael F is asking, is this an iron condor? That's exactly what this is. So we combine two spreads. The bottom spread, the put spread, is called, here's some just verbiage for you that you can kind of remember, is the bottom spread is called a bull put spread. We call it a bull spread because it's based on the stock going up or staying above this spread, and it's a put spread because that's what we're selling is puts. And the top spread is called a bear call spread. You can probably figure out why it's bear because our calculations are that the stock is going to stay below it, below this spread. and it's calls that we're selling, so it's a bear call spread. You combine these two, and it's an iron condor. So that's what we're doing here. Now you can see that the SPX is going up, probably up here. If I was actually doing this, what I'd probably do, since we do have an uptrend and we are going into earnings season, I'd probably bring this one up a little bit and bring this one up a little bit to take into consideration the trend, take into consideration that this is rising. You want to watch the trend of the stock and take that into consideration. And what's going on? Could you please make the chart bigger again? You know, I don't know why the chart's little. Morgan, I don't know if you can help us out. I want to make this bigger too. I don't know what happened. There we go. Just as easy as clicking on it. That was easy. Okay, can everybody see it a little bit better? Thanks, Sanford. That is better. It's better for me too. I thought I was the only one that was seeing it little. Okay, cool. This is great. So do you guys kind of get the gist of this? Is what we're trying to do. Okay, imagine this. Okay, imagine that there's a lot of money waiting for you if you can just stay away from this big old boxer that's in the ring. And all you got to do is stay away from him for, 3 minutes. So this is 3 weeks. We're going to say we're going to stay away from this big boxer for 3 weeks. He's big and he's slow. He can really pack a punch, but he's swinging at us and we're small and we're light and we're darting around. And all we got to do is stay away from this guy for 3 minutes and win the round. That's all this is. You're trying to sell spreads where the stock isn't going to be. And think about the difference between that and directional trading, particularly with options and a lot of other things. You got to be so precise when you're buying options. You got to be right on the time and the direction and exactly where that's going to go. And most people set targets for exits, and you got to be right on the money with that target. Well, here's what's cool about this strategy, and this is why people really get to liking it and get so comfortable with it and do it, is because selling options like this is kind of like horseshoes in hand grenades. Close is good enough. Maybe you didn't peg that stock exactly. Maybe it didn't do exactly what you thought it was going to do. But you know what? It stayed away from your spreads and it just bobbed along. It went up and down. It did all the crazy things stocks do, but it never touched your spread and it just expires worthless and you get to keep the money. And what you'll find is that just keeps happening over and over and over again. So let's see what else we got here. So this is an iron condor, and this is a really, really favorite put strategy. Okay, so we're all excited about that, and that's really great. And a 25% return for just 3 weeks of time is huge. And by the way, that's kind of what we're shooting for here, is 25%. But here's what you always got to be asking yourself, and if you're a little bit skeptical, you're probably going, oh yeah, great. This is fantastic. It sounds really good, looks like fun. But what happens if the trade goes against us? What happens if things really go bad? What do we do? Because it's great when everything's working out, but hey, I don't like the idea of making 50 cents or making $1 and losing $4. That doesn't work too well. So let's see what happens when trades go against us. And once we know that, and once we know what to do, it just takes all the fear out of trading this way. So let's just say that the SPX is going along and it just decides to fall out of bed. It just drops. Okay. So all you folks, if you're a trader right now, I guarantee you that you know something about technical analysis and charts. At least you know what support and resistance looks like, and you know what trend lines look like. So we've just drawn. This is real simple technical analysis. We just draw a trend line under the SPX. It goes all the way back. If you line this up, this is kind of pretty much what it looks like. So if the SPX was to break this uptrending support right here, would that kind of give you pause? Would that make you look and say, don't like that. Maybe we got a downtrend going here. So you're watching it, and what do you know? It breaks horizontal support right here, and it's going down. Would you start getting a little bit concerned about this put spread that you have down here? So in the worst case scenarios that everybody always talks about, they always talk about a stock plunging right through both of your spreads, both of your sold strike or your strikes here, and you're losing the maximum amount of money. And I'm just telling you, I've been doing this for a long time. I make a good chunk of my living out of bringing in this kind of income. And I virtually almost never have the stock go through. I'm not going to say never because stocks can gap and they can really move and they can explode. But just about never. I mean, you get warnings. So here, let's just say the SPX rolls over. You got one warning here where it broke the uptrend, and you go, don't think I like that. You got another warning here where it broke what should be fairly strong horizontal support, and now it's continuing to go down. Should you think about closing this spread right here? Yeah, you ought to be watching it, and you ought to think about closing it. Now, you got another layer of horizontal support right here, and this is one of the keys is we're selling below several layers of horizontal support. So this stock really has to reverse and go lower. This index does before we start, having to take notice. Right about here, when this level of horizontal support gets broken, you should consider selling the spread. You should probably sell it. Now, let me give you a last ditch spot to close your spread. Right here. When your sold strike gets touched, you automatically close. You don't ask any questions. You don't ask your mom, your dad. You don't screw around. You close that. In fact, here's my stop loss, my automatic stop loss. Is I enter orders to automatically close that spread. And when I say close, I mean you sold this one and you bought this one. So you have orders in there to automatically buy back what you bought and sell, or excuse me, buy back what you sold and sell what you bought. And that's actually closing the spread. Now, somebody asked in here, they talked about, do you close both sides? Well, if you've really got a lot of momentum going down, and this is what some of our traders do, some of my subscribers, and I actually teach this in the course. It's really, really cool to do. If you really have a lot of momentum on the downside, you can buy back what you sold here, and you can let the index or the stock completely overrun, and you'll start making money on this put right here because you own it and you bought it, and now you don't have a sold put. So this can get pretty exciting, but that's kind of fancy, and it takes some conviction that stock's going to head lower. So for right now, for this conversation right now, we're just talking about closing these two. So remember how we talked about you could potentially lose $4.50 if things went against you? Well, if your last ditch close is always your stop, in essence, is always when your sold strike gets touched. Now you could have closed it here for a lot less money, could have closed it here for less money, absolutely should have closed it here and spent less money. But if you let it go all the way down here to where your sold strike got touched, the most it's going to cost you is about half of your maximum loss. So, it might cost you on a $5 spread about $2.50. Probably it's going to cost less than that if you've had some time decay since you put on the position. So I just want to let you know when you're looking at these and when people are talking about iron condors and selling spreads, it's really, really difficult to lose that maximum. So you're never really risking that much, especially if you have some automatic close orders in on your trade. So that's how we defend against a trade that's going against us. It's going down and you close it. Now, something I have to point out is the closer it gets to your sold strikes, the more it's going to cost you to close this. So maybe we took in $1. Well, maybe it costs you more than $1 to close this. But once you close it, you've removed all further liability. You have no more risk. And you're in really good shape because you don't have anything to worry about. But you might have once it's closed, but once you might have spent a little bit more than you made. So how can we offset those closing costs? So what can we do? And somebody earlier asked about adjustments, and so let's just take a look at what we can do. So close and roll to another condor. So here's our original condor right here, right? And it went down. So let's say that the stock is right here, right now, and say the index is right there. So it touched your sold strike and you close this. So what you do is we're going to close both spreads. We're going to close this one because we really need to remove our risk. Well, the cool thing is since it's gone all the way down here, this one, this top one, this call spread up here has very, very little value. So it costs us very little to close it. So you say, well, if it has very little value and it's not worth much and it's probably not going to get overrun, why should we close it in the first place? Well, the reason that we're going to close it is we free up all that margin to open up this spread right here. So what we're going to do is we're going to close these two spreads. We're going to close our original spread, these two right here, and then we're going to open up a new spread. So we're going to do maybe the 1845, 1850, and then we're going to come down here and we're going to do the, whatever this one happens to be, probably the 1690, 1695. So can you see that? We close this spread, we open this spread, and here's been my experience. We bring in a lot more, more than enough money to offset it. Now, sometimes you're going to have to sell a little bit more time. See, we sold out here to the end of January. Sometimes we might have to sell a weekly out here to, a week or so into February. Okay, that's possible. Sometimes you can actually sell the same expiration. So what you're going to do is you're going to free up your margin. You're going to free up your money here, and you're going to use that money to sell a new spread and bring in some new money to offset your closing costs. So anyway, that's what here. Let me just. Everybody's saying you can't see my cursor. Okay, so I'm going to get back here and can you guys see my cursor now? I don't know. Can you see a cursor? No, can't see it. Okay. Well, let's just hear. How about this? Now can you see it? Yes. Okay, great. Now I can start pointing at stuff. Good. Glad. All right, now you can see what we're doing. So you can see that we're going to close our spread up here on the top. Now here's our scenario. Here's what happens. So what I'm trying to teach you what to do here is just to not be afraid of having to adjust stuff. So stocks go up and down, they go sideways, they go all over the place. We all know that. And we use technical analysis to try and determine where they're going to go. Sometimes they surprise you. So most of the time, the stock is going to stay away from our sold strikes. It's just how it works out, about 80% of the time, and we're going to get to keep all the money. So what we're talking about doing right now is what happens when things go bad. So if you know what to do and it's just automatic for you when things go bad, you're not going to worry about it. And that 20% of the time that you have to do something, you just calmly and easily go in there, you take care of it. So what we do is we close down our existing spread. So we close this spread, the top spread, we close the bottom spread, and then we open a new spread. And we take in more money that more than offsets the amount of money that we spent. And I'm going to show you an actual case where we did this. But here's the difference in the case I'm going to show you. It's a lot scarier than this one. And it's a real life example that just happened to us about a month ago. When you see this, if you're already selling spreads and selling iron condors, when you see this, you're just going to cringe. You're going to go, oh my gosh, that's my biggest nightmare. Well, wait till you see what we did and wait till you see what happened. So I think it's just so cool to see the worst case scenario right up front. So you go, okay, well, if that's the worst thing that can happen to me, I'm not worried. I can handle this. I can do this. So for you, those of you that are options traders, when you buy an option and the stock reverses and your option gets cut in half or down to a quarter, or practically nothing, what's your alternative? What's your plan B? You don't have one. The most you can expect to do is put a stop loss in there. Well, here with this, I mean, it's so cool because we can really do stuff. So, yeah, so what happens, I love this picture. So what happens if disaster strikes? What happens if the stock gaps big against us? I mean, it just absolutely goes crazy. Now, so everybody talks about when people don't trade iron condors and they don't trade spreads, or if they traded them once or twice and they didn't have a good education about it, and they lost the maximum, they go, well, what happens if disaster strikes? What happens if something really, really bad happens? So let's take a look. So this is a real trade, okay? Here's a real world example. So what I did is I pulled this chart right off of our subscription service. So this is exactly how I present a trade. If you come on board with this is what you're going to see, and this is my commentary right here. So CF is a fertilizer company. They're trading along in this. Would everybody agree with me that this is a nice, predictable channel? And would everybody also agree that we're actually selling our spreads outside of this channel? So it can keep going up, it can keep going the direction that it's in. If it's at the top of the channel at expiration, we're going to be fine. If it goes down and bobs along here and it's at the bottom of the channel at expiration, we're going to be fine. So this is what we're looking for, is a nice, predictable trend. And so we sold the 230, 235 call spread, and we sold the 205, 200 put spread. So can everybody see that? Can everybody see what we're doing here? Does this look like just a nice bread and butter spread trade? Does this look like something that we can do? Yeah, me too. This looked really safe, did the research. read all about the stock, made sure that we weren't going to have an earnings announcement or anything going on while we were in the trade. And as you can see here, we're doing this right here at the end of November. We're only going to hold it until the 23rd is actually the Monday after expiration, so we're going to hold it to the 20th of December. Not going to be in the trade that long. This looked nice. Well, most of the time, trades work out great. They're just nice and easy squeezy. We just kind of casually keep an eye on them, make sure that they don't get too jiggy on you, and then you just collect the premium, and it goes till expiration, and you keep it. That's what happens most of the time. So this is the boogeyman sitting in the closet for spread traders. Holy mackerel. Okay, so going along right here in our channel, everything's going great. Look what happened. This thing gapped straight up over $30 in one day, and it went right through both of our strikes. And here's what it did: is the company decided that they were going to change their corporate structure from a corporation into a master limited partnership. And I don't know if you know about master limited partnerships, but income traders absolutely love them because they pay out about 80 or 90% of their earnings to their unit holders, and they're fantastic for income. They've become really popular over the last few years. So when this company decided that they were going to turn themselves into an MLP, the stock just shot straight through the roof. Well, what did we do? Well, we had automatic orders to close this thing at 2:30, and I can show you actually how to set those up with Thinkorswim. And so fortunately, we closed this thing at 2:30, and it went up fairly fast, but it got us out. It cost us some money to do that. I'm going to show you how much it cost us. But look at this. I mean, look at this gap. Now, watching this thing, a lot of the time, as you know, if you trade stocks, when you get a huge up spike like this, you get some retracement. A lot of the times these things retrace, and this retraced the very next day and closed on the low of the day. That indicates to me it's going to come back down again. So here's what we did, and here's what you can do. Okay, so we kept the same expiration. We kept December 20th. So here is our original spread in black here. Can you see that? So here's our 230, 235 spread. We closed that. And here's our spread down here. Here's our 205, 200 spread. Close that. Easy as a few mouse clicks. It's not difficult to close a spread. And on Thinkorswim, you can close both legs with one click. Very, very easy to do. And you can open new legs with one click. So what we did is we went up here, we sold the 245, 250. As the stock was starting to retrace and come down, a lot of the time they like to move back in here to the gap. And I figured this is a really safe spread. I think it's going to come back down. On the downside, we see we've got good horizontal support here. I didn't figure it was going to get below horizontal support. So we sold the 220 and bought the 215 to hedge. So let's just take a look at our math here. We'll get into the TOS training. It says that DigiV, how to do that on TOS. I actually show that in all my educational material how to do that, but we'll also take a look at the TOS platform before we leave. I've got some good slides on that. So we closed the top spread for 220. And we originally collected for both sides of the spread, we collected 85 cents. So 220 is a pretty big hit. So when this happened, when this event happened, when the stock hit our sold strike, we closed it for $2.20. The bottom spread down here wasn't worth much with the stock way up here, so we closed that for 10 cents. Okay, so that is a combination. Our cost to close is $2.30, and you can see that down here. So on the top spread, it costs us $2.20 to close. The bottom spread for 10 cents, and that's a total cost of $2.30. So when we initially put this spread on in the first place, we initially did this, we collected 85 cents. Now 85 cents on a $5 spread, so you go 85 cents divided by $4.15, that's a 20% return is what we were shooting for, so pretty darn good. Well, we got this 85 cents, well, because there's such a huge increase in volatility here when this thing jacked way up. I mean, the options just go crazy on this stuff. So the volatility on the calls went through the roof, and it started to retrace, and the volatility on the puts went through the roof. So when we sold, and we gave it plenty of room to move, if on this new spread, this green spread, we got $1.74. So the first time we took in 85 cents, the second time we took in $1.74, that equals $2.59 in total credit. Can everybody see that? First spread was 85 cents. Second spread is $1.74. We got a total of $2.59. Now, when we went to close our first spread, it cost us $2.20 on the upside, cost us 10 cents on the downside, so that's $2.30. So our total cost is $2.30. So our net on that trade, even after the thing gapped like crazy and this big disaster and all your hair stands up on end, our net on that trade was 29 cents. So you divide the 29 cents by our new margin hold, and that was a gain of 9 cents. So what I'm showing you here is about one of the biggest disasters that can possibly happen to you, and you got out automatically. You didn't even have to worry about that. You didn't even have to watch it or freak out or do anything. You're just out of the trade. You know, you could be out having lunch, playing tennis at work, taking a nap, whatever, and you're automatically out when something bad happens. I think this is really, really important. The reason I do this strategy is to be able to relax and bring in money on a really regular basis. I don't want to be freaked out. I don't want to be watching our trades. You know, I mean, I do it because I have a service, but I'm talking about for you. I don't want you to have to be watching this every single second. So we enter these automatic orders to buy it back when we get in trouble, and then we can turn right around and sell a new spread, and that's what we did. So I want to show you how kind of the math worked out on this. So I'm going to go back to my, here. I'm going to go back to my little pen. Well, heck, this will work. So CF, this is our first one. We sold the 230, 235. And this is, if you want to take a look at this, I post all my trades on our track record, and that is open to the public. You don't have to have a subscription to take a look at that. I think if you're going to be teaching an option strategy or any trading strategy at all, you should open your record up for everybody and let them take a look at it. That's the only way anybody can make an educated idea of if that's what they want to do. So this is the current month isn't displayed, but last month is. So we did this in December. We just put that up. You can go take a look at it. And this is just part of the track record because we did you know, about 8 trades or so in or more trades in December. But here's CF. So you can see what we did. So when we originally did this, we sold the 230, bought the 235, and we took in 35 cents. We sold the 205 and bought the 200, and we got 50 cents. So that's 85 cents, and that gave us a margin hold of $4.50, 15 cents. If you divide 85 by 415, you should get right around a 20% return. So what happened is we closed that, and we say right here we closed on 12/4. That's when that happened. It cost us $2.20. We closed this one on the same day for 10 cents. And then right over here it tells you what we did. We rolled to the 245, 250 on this top spread. And on the bottom spread, we rolled to 220, 215. And we're keeping the same expiration. That's exactly when these are going to expire. So we're not tying our money up for it any longer. So we sell the 245, 250. We get $1.24. And we sell the 220, 215. We get 50 cents. So that's $1.74. And so we go $1.74 minus the $1.45 from the roll equals 29 cents. So, you know, we subtracted our original dollar from that. Here's our new margin. We get 29 cents divided by 326, and we get 9% on that particular trade. So, you know, you might be asking yourself, okay, well, if this is what you can do in an absolute disaster and in a worst case situation, is it even possible if you know what you're doing to lose money on this? And yes, it is. You can lose money on any trading strategy, but I'll tell you what, this is the easiest one to make money I have ever found. It's just, and the reason is what benefits you, what makes you money is the passage of time. When you sell an option that is out of the money, the only value that it has is time value, and every passing day that time decays. Until you get to expiration, it's not worth anything. So if in many cases, if you just fall asleep at the wheel and it just trots along, you're going to make money at expiration. Occasionally, you do have to wake up and make an adjustment, and that's fine. You know, we can do that. This is still the easiest way to make money that there is. We had a trade recently on Netflix. Netflix fell out of bed. We rolled it down. That didn't work out. It kept going down. So what did we do? we turned right around, and Netflix is looking really bearish right now. We sold a call spread. We sold above it, and now Netflix is heading away. And that one we'll lose a little bit of money on, not much, and we have a nice call spread to bring in some more premium on it. So I love these things. Once you get used to this and kind of get a feel for how it works, what you'll like about it and what I like about it, and the reason people do it, is you have such a good chance of winning. You're just not nervous. You're just not worried. You're just going, man, all other things being equal, I'm going to make money on this. So the beautiful thing about credit spreads is you have options. There's almost always something you can do to make a trade better. And that's when you're selling credit spreads. You can always turn around and sell something else. But one of the things that I have to tell you is you don't use all of your entire account. You keep 10, maybe 20% of your account set aside for cash so that you can do buybacks and rollouts. But the rest of your account is making really, really good money. I'm going to stop real quick. I got some good time left, but I'm going to answer a few questions. Let's see, where's $1.45? We could go through the math again, but it's you took in, I think the first math was correct, where we took in 85 cents and then we took in $1.74, and that was our total that we took in, and then you subtract what it cost you, and it cost us $2.30. Please address commissions. Cam says address commissions, and I am going to do that, but here's the thing, is with $5 spreads, you're not doing as many contracts, so your commissions are not as much. We also do a lot of $1 spreads because your returns are better, and you can also do some things with $1 spreads that you can't as easily with $5 spreads. And there you're going to do a lot more contracts, so it's going to cost you more money in commissions. But here's the deal. I have been negotiating with Thinkorswim for many, many years, and what I tell them is, our traders are not regular traders. We trade credit spreads and we trade a lot of contracts. So in light of that, can you give our traders a little bit better deal? And we finally got a really good contact at TD Ameritrade, who owns Thinkorswim now, and they said yes. If your subscribers are trading a certain number of contracts, they're very active, we're going to give them a better deal on commissions, and it's pretty darn good. And I don't want to say what it is because I don't want to get them in trouble, but what I will do is if you come on board, I'm going to get you in touch with our contact at TD Ameritrade, and they've made a lot of our traders really happy on commissions. What rules do you use to pick a stock? I use a lot of, I do watch the moving averages, I look at trends, I look at the MACD, I look at a lot of the technical indicators that you're probably looking at. I'm looking at trend and direction, and the other thing that I take into consideration is the overall direction of the market. I do not want to sell against the market. Okay, let's keep going here, and I'll answer some more questions at the end here. Oh, by the way, people use different brokers besides Thinkorswim. Here's the really cool thing about Thinkorswim. We'll get into this in a minute, but Thinkorswim, I have had options brokerages at just about every single options broker you can name. Options Express, Option Monster, Trade Monster, Options House, and here's the problem with just about all of them is it is very, very difficult for them to get you in between the bid-ask spread. So you're going to end up buying at the ask and selling at the bid. And on $1 spreads, all of our spreads, that makes a huge difference. So what Thinkorswim is so darn good at is getting you in the spread. And they have great analysis tools. Thanks, Kurt. Can Aussies get an account with Thinkorswim? I'm not sure about that. They used to be able to do that. I don't know if they can now. I know Canadians can, absolutely. And Aussies may be able to. You might want to contact them. They seem to go into that market and come back out of it. Yeah, Matt says he got them to reduce commissions. They'll negotiate, especially if you are trading credit spreads and you're trading a lot of contracts. Now keep in mind, when we're doing, say you do 10 contracts, well, if you do a condor, you're doing a spread is 2 legs, so that's 20 contracts right there. Then you go up to your top spread and you do 2 legs right there. That's 20 more contracts. That's 40 contracts on just a 10 contract position. So you're trading a lot of contracts. You are a good customer to them. They do not want to lose you. If you're consistently doing that, they're going to give you some really, really good commissions. And the platform is absolutely the best. Okay, so extraordinary returns, that's the name of our webinar. So how are we going to get those? So speaking of making trades better, how can we improve our returns while reducing our risk? In other words, how can we create extraordinary returns? We want to do a lot better than what the average credit spread trader is doing out there. So if you're familiar with credit spreads, if you've ever been with another service, if you've done them yourself, a lot of outfits out there are recommending selling 2 months at a time, a month and a half. I've heard, some people think the sweet spot is 45 days. You're tying up your money for that amount of time. And they're maybe going for, I don't know, 7-8% returns, maybe 10% returns if they're getting kind of racy. So how can we do better than that? How can we do substantially better? We want extraordinary returns, and we don't want to go out on a limb to make them. We want that feeling of safety and confidence. So what can we do? So we're going to take a look, right, and this is a good time to get out your pencil and paper. We're going to look at 5 strategies to reduce your risk, increase your returns, and increase your frequency of returns, because how fast you turn your money is actually really, really important. Okay, so 5 strategies. So our first one should be fairly obvious, and this is getting back to our technical analysis. So sell outside of a stock's range, paying attention to trend and direction. So here we have the Russell 2000, and once again we can see it's bobbing up and down, but it's doing so in a fairly well-defined channel. So here's the thing with this. We are actually adjusting this condor higher, even though we're selling, we're selling in both cases down here at expiration just outside of the channel, and on this side we're selling well outside of the channel. The reason we're adjusting this condor higher is because the rut is in an uptrend. So right now the current price when we did this, and we actually just did this yesterday, we put on this trade. This is an actual trade. And this is my commentary. And this is exactly what you'll see when you come in and trade with us. So the rut has been moving in a well-defined pattern higher, so we'll be selling well outside of its range, giving it a little more room on the upside. We want to acknowledge the trend, acknowledge the fact that we're going into earnings, it's probably going to be bullish and the rut's probably going to move higher. We want to give it plenty of room to do so. So in this case, because we're selling a little bit closer to the downside, we're going to get a little bit more money on this put spread than the call spread, but that's okay because our goal is to not have our sold strike touched. So I also want you to take a look at when expiration here is. Okay, so this line goes out to 20th, which is the Monday following expiration. This ceases to trade actually on the Thursday of expiration week, which is next Thursday, the 16th, and then it settles that next morning on the 17th. So we don't have much time on this. We just sold this yesterday on the 8th. It's going to cease trading on the 16th. That's a little more than a week of time. That's 4, 5, 6, 7 days of time is all. And what are we collecting on this? Look down here at the bottom. We're collecting 22% in 8 trading days. This is, for credit spread traders, these are phenomenal returns. And we're shooting for between 20 and 25% on every trade. Now, if we just end up doing one leg, we might do 15% on a leg. But we just did one on Google last week, and we just sold a bull put spread because Google's been going up so much, and we just wanted to go underneath it and just give it all the room to run in the world on the upside. And on that one, I think, gosh, we got, I don't know, we got something like 20% for just selling one leg. So you can do it. The neat thing about condors is you get to widen out your spreads a little bit more to give yourself a little bit more room. But this is what we're shooting here for, and this is a pretty extraordinary return for credit spread traders. Mike, yeah, I love this. You're saying all I see is yeah. That's great. I appreciate that. But you know what? Here's the thing about channels is most of the time they ring true. Most of the time stocks stay in them. That's why support and resistance work. So it took a pretty extraordinary event for that stock to break out, or for any stock to break out. And Joe M says, are you looking at the 2 to 3 weeks time frame? Yes, I am, Joe. That's absolutely my sweet spot. And I've done a lot of experimenting around. I'm going to tell you why I picked that time frame. That's going to be one of our strategies here. Oh, Kirk M's got a rut trade on. Good for you. I bought it for free. Good for you. I love it. Man, I love presenting to traders. You guys are sharp. Okay, so that's our number one, is acknowledge the trend and use your technical analysis just like you would for directional trading. The difference here is you just don't have to be as good. You know, close is good enough, and the majority of the time you're going to win. So number two, make sure your probability of winning is at least 80 to 90%. Okay, so let's go back to this original trade that we took a look at. This is our SPX trade where we sold this bull put spread. So we sold the 1775, remember, and we bought the 1770. So how do we know this trade is between 80 and 90%? Well, here's one of the cool things about options, and one of the things I really love about options, is it's all based on the Black-Scholes model. So if you're familiar with the history of options, Black and Scholes were mathematicians, and they came up with this formula back in 1973. They were finally in 1998 awarded the Nobel Prize in mathematics for this formula, and it actually allowed the modern options market to operate like it does. And that is why the CBOE was actually formed back in 1973, is because for the first time ever we had a pricing model that worked for everybody, buyers and sellers, and we could come up with standardized pricing on options. And I think that is so cool. We have this mathematical formula. So once you have a formula, the next question is that's fantastic. How do we take advantage of it? And if you're curious about this, if you're a mathematician, here's the Black-Scholes formula. Here's what it actually looks like. And over the years, they've actually modified this a little bit. There's other formulas, but they're all based on this. So how can we take advantage of this Black-Scholes formula to make us money, this Nobel Prize winning formula? Well, fortunately, we don't have to do the math. We don't have to figure out our probabilities because Thinkorswim has done it for us. So let's take a look here and see what we got. So remember, we sold the 1775. So can you see that right here? We're on the right side. I don't know if you're familiar with the Thinkorswim platform or not, but I just absolutely love it. So let me show you a couple things about the Thinkorswim platform that I think you're really going to like. It gives you some really, really good information. So right up here, there's a drop-down box, and if you click this little corner here, it'll give you all these different things that you can put in your columns. So we've got, you know, probability of out of the money, the delta. That's what we've selected, and if you're going to be an options seller, that's what you should put it on. The reason is it shows you the implied volatility, and you know, you can sell when it's high, relatively high, and it shows you the probability of being out of the money and the delta. So we go down here, and our probability of being out of the money on this particular option that we sold is 83.96%. So we can just call that 84%. So my question is that between 80 and 90%? Yes, it is. It's a good trade for us. Can you see here where we're going to sell it for 520? We're going to turn around and buy the 1770 for 470. And you'll notice I stay on the same column. I stay on the same ask column. Now, normally at most brokerage houses, and this is why I absolutely love Thinkorswim, they're going to make you buy this option at 470. They're going to make you sell this option at 490. If you do that, there's just a 20-cent difference between the two of them. Can you see how valuable it is to get a broker that will let you actually, what I call it is the bid or the ask. Either one, there's a 50-cent difference. You go down here, we've got this trade all set up, and it shows you your credit, 50 cents. So they actually have the ability to go in there and work the market and get this maximum amount of money. So the difference between a 20-cent credit and a 50-cent credit is absolutely huge, and it's even bigger when you go on the other side and do your call spread. So this is just on one spread. That's the difference. And like I said, I've tried a lot of other brokers, and I just absolutely love these guys for this reason. So the main thing that I want to show you here is how we have an 84% chance of winning. We do trades all the way from the low 80s. The low 80s is a little bit, I don't like to get down there too much lower than about 81, and we do them all the way up to 90%. So anyway, we're getting kind of running low on time here, so let me just cruise along. Number 3 is make time decay work harder for you. So here's an options time decay curve. This is out 4 months, 90 days, 60 days, and 30 days. And this is 0 days. So here we are at a month right here, and our sweet spot is we're going to sell between 2 and 3 weeks of time. And what I want you to notice about this time decay curve and what's so cool about it is, see how it's kind of flat in here, gradually gets steeper, it gets a lot steeper here, it really starts to steepen up right before the second month out goes to front month, and then it just starts to absolutely go straight on down. And we're going to be selling right about here, about 2 to 3 weeks out on the time decay curve, and that time decay is working for you every single day. It's just absolutely beautiful. Number 5, get bigger credits. Okay, here's what I mean by that. Okay, so this is a spread that we just put on once again yesterday. This is on the SPY, and we did a $1 spread. Once again, I'm showing the actual commentary that I showed to subscribers here. And what we did is, so if you look at yesterday's candle, see this big red candle right here? Okay, here's the natural. Now the natural is if you're buying at the ask and you're selling at the bid. It was 8 cents on one side, plus 5 cents on the other, and that was a total of 13 cents. That's what you would get probably at most brokerage houses. So divided by 87, that's your margin hold. You get a 15% return there. Not bad, that's okay. But here's what we did, is we know that Thinkorswim works it in our favor as much as they possibly can. And we know that we just took the range of the S&P. If you look back here and you look at the range that the S&P typically moves, and fortunately we got a nice, decent range yesterday with that candle, we say, well, we think we can get a little bit more on the put side and a little bit more on the call side. So we put our order in, instead of 8, we put it in at 11 cents, and instead of 5, we put it in at 9 cents. And here's what we got. Now, what the natural showed up at Thinkorswim was 9 and 5, or 6. But we got 11 and 9, so we got a total of 20 cents divided by your 80-cent margin hold. That's a 25% return. Look at the difference between these two. So what you do is you reach a little bit for your credit, and most of the time, about, just the vast majority of the time, you're going to get filled just by the natural fluctuation. So this is a way to get much, much bigger credits. And like I say, we're typically going for about 25%. So here's what we've actually been doing. So here's we've divided up our portfolio. You get 2 trades a week, and I've divided them into aggressive trades. Those are usually about $1 wide spreads, and retirement trades, and those are $5 wide spreads. So this is our track record for December. These are all the ones that we put on. This one, let's see, we closed this at 23. That was just a 2-cent debit. And the IWM, we rolled down here, we got 15 cents. So we subtract the 2 cents that was left over from this one when we rolled it, we got 13. And on an 85-cent margin hold, that's a 15% return. This expired worthless, we got a 25% return. Our trade on the FAS, our Condor on the FAS expired worthless, we got a 25% return. And once again, the IWM, 15%. And then the TBT, we got some really, really fat credits, and we got a 35% return. So our average on our aggressive trades was 25%. And let's take a look at our time frames. All the time frames here, we've got 11/29 to the 13th, so that's about 14, 15 days. It's about 2 weeks. This is 12/4 to expired on the 20th. That's about 16 days. 12/11 expired on the 20th. That's 9 days. 12/11 on the 20th again. That's 9 days. And the 18th to the 27th is 9. Let's see, 9 days as well. So most all of these, if the average amount is less than 2 weeks, and so that's what we're kind of trying to turn our money, is twice per month. Here's our aggressive trades. Here's that CF that I showed you. We ended up making, if you remember, 9% on that. Got 12% on our BA trade. Got closed it a little early, but we still got to keep some premium. Made 12%. We made 23% on our Amazon, 19% on Google, and we rolled down Apple. We ended up taking in a huge amount of credit. We ended up getting 63% on that. So if you add all these up and divide them, we got 25.2%. And it just varies. But generally speaking, we're winning. When a trade goes against it, we roll it, and we usually end up either making a little bit of money, breaking even, or losing a small amount. So what's possible? What do you think is reasonable to expect? And our target is 25%. So do you think you're going to get 25%? Do you think that's possible? You know, I don't know. So, you know, there's a lot of things that can lower your rate of return. You can have some losses in there. You can have some commissions. We're not going to be using our whole account. So do you think you could do 20%? In fact, what I'd like you to do is just write in what you think that you could get. Now, if our target's 25, what do you think is realistic on this? And let's see. Maybe we could get 20%, 15%. This is every 2 weeks. So we got 25%, 15%. We've been getting 25%, but we're not using our whole account. So George Juan says 15 to 20. I think that's fairly realistic. George H says 15%. Sherry says 20%. Lewis says 18%. Jerry 12%. Ming 15%. Okay, these are all really good. This is kind of similar to what we've been getting. But what if you only got, oh, let's get it down to 15. Do you think you could do 15 pretty easily? Let's be more conservative than that. What if you could get, even with losses, factoring in losses, 10%? Yeah, you could pretty easily get 10% every 2 weeks, don't you think? Well, let's go even more conservative than that. Let's get something where, yeah, 10% would make me very happy. That's right. You can make a lot of money on 10%. Juan says he'd be happy with 5%. You know, let's forget the 25, the 20, the 15, the 10. Let's go all the way down to 5%. Let's say you started off trading this with $10,000. Let's see what your account turns into at the end of a year. If you're turning your money twice a month, that's every 2 weeks, at just 5%. Now, this is the magic of compounding. At the end of your first year, your account's grown to $32,251. And this is why I said this is so much like it's really a wealth building strategy. You know what's cool about compounding? Let's take a look and see what it does for 2 years. Holy moly, your 10,000 grows. You know, go out on your own, plug these numbers into a compound interest calculator. It's actually going to kind of blow your mind. So we're getting 20, 25% every 2 weeks. If you got 5%, if you were terrible at this, the reason we're not going to get 25% is because we're going to set some of our account aside, and we're going to diversify it between a lot of different trades. We're not always going to have our entire account working. So, but I'm just trying to be super conservative here and get it down to 5%. And the reason I'm showing you this, obviously this isn't how the real world works, but it kind of really gets your wheels turning. So if you want to do this, it's super important for me that you're successful trading this way. So I want to make sure you've got everything you need. And so I put together this incredible package for you. It's got some really good education. There's so many cool things that you can do with this that I'm not showing you in this presentation. I just don't have time. But the whole package is at creditspreadswebinar.com, and I think Morgan might have it up here somewhere. And if we could put it up, Morgan, that'd be great. So creditspreadswebinar.com. Write that down. You can go there. The whole package is there. And to make sure you have a really good understanding of how this strategy works, you get a complete video presentation called How to Trade Credit Spreads for Fun and Profit. That'll get you started off right. Put together this huge package. I've sold this for an awful lot of money in the past. Well over $1,250 is what we usually sold it for. And it's got everything in it. And I've really got this at a price where you can, thank you, Morgan, I appreciate that getting up there. And here's everything. It's a 161-page downloadable ebook. You get 15 chapter video series. You get 14 separate audio files. We've got all of our archived webinars. Every time we do a new webinar that shows you something new, you can access those. These audio files are great. You can listen to them in your car, on your iPod, anywhere. And you'll also get all new webinars for life as an owner of this package. So it's super, super complete. There's a lot of really cool stuff in there. In addition, you'll get 3 videos. Now, somebody was asking about this. How do you set up these automatic orders? You get 3 videos that show you how to set up automatic orders with our favorite broker for spread trading. And these videos show you how to get out of your trades at the perfect moment, whether you're watching the market or not. In addition to that, I'm going to include the subscription is $97 a month. I'm going to include that in this package. You get 2 new high probability trades every week, and I'll show you exactly where to sell your spreads and exactly how to sell them. for the possibility of maximum returns. So the subscription's really cool, really fun. We do really well with it. As an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. And this has been our most popular course. People absolutely love this. They ask if they can buy it by itself all the time. I'm going to include this in the package. And I'm also going to get you in touch with our contact at TD Ameritrade to get you some discounted commissions. So in short, this is a train you don't want to miss. And I'm going to conclude. I'm going to wrap up. Looks like I'm out of time here. So come on board, prove to yourself how well this works, and then watch your account build. So to get everything we've talked about and to put your feet firmly on the path toward building wealth through some pretty extraordinary income, go to creditspreadswebinar.com. And I'll just tell you real quickly, the whole package is normally $395. You can get it through Morgan right here at this particular link just for being here. For $200, we're going to add on the subscription for you for $97. You get the whole thing for $297. We just do never discount it. It's never on the website for that amount of money. It's just here for that for you right now. And you start trading this way, you're absolutely going to love it. So appreciate you listening. It's a lot of fun, and thanks for being here.